What is up, fam? It is our favorite day of the month. That's right, it is the FOMC meeting. Today, we are going to see our favorite people, Gina, and I guess more importantly, Mr. Thanks for joining us again. These have become our channel's biggest days of the month. I'm loving it. We've taken what is typically a pretty boring interaction, pretty boring thing. Usually these are pretty dry. We try to spice them up a little bit. I walk you through kind of my thoughts, commentary, etc. On what POWELL is saying and what it means. And so let's start in an unusual way. Let's start by just quickly kind of going over what is the Fed? What is the Fed's job? What are they doing here with these meetings? Why are we talking recession? Why are we talking inflation? What are the factors behind them, etc.? So let's get hype, guys. Let's get easy 1,000 likes on this video. Let's do it. Smash it right now. Each time you hit the like button. Ooh, we already broke our scribe virginity. Every time you hit the like button, chat, engage, etc., YouTube shows this stream to more people, so it makes a huge difference. Please, please keep doing it. Shout out to our sponsors, but no time for that. So what is the Fed? Well, first and most importantly, the Fed is not actually part of the government. It is a private, I don't know, business, I guess, or organization that's tasked basically with the financial policy of the U.S. Simply put, the Federal Reserve System is the central bank of the United States. It's simply referred to as the Fed commonly. It's arguably the most powerful financial institution in the world. So when they speak to us directly, the most powerful financial institution in the world is speaking to us. And that means we need to listen. The Fed has a board of 7 members. I think there are also 12 Federal Reserve banks with their own presidents, but we won't get too deep into that. So a little background on the Fed. What is their job? Their job is to manage unemployment. This was tasked later after the Fed's creation, unemployment. But most importantly, fiscal policy. I do believe actually maybe even since the last live stream, they fact check me here, guys. They may also have gained a new task of something to do with equality, something to do with, I think, wage equality, something like that. Maybe I'm wrong. Maybe that was a clickbait article. Something about it. I read a bunch about it, though. Something to do with that. Maybe they have a third task now. So they use their tools available to them to keep unemployment low and to keep fiscal policy balanced. The problem is we have seen not necessarily unemployment get out of control yet. We did in 2020, but we have seen fiscal policy get out of control. CPI, or inflation numbers, have been record-setting. Last month, coming in at a 40-year high, I think of 9.1 or something, a ridiculous amount, which basically means if you didn't get a 9.1% raise versus last year, you're losing money. If you didn't get a raise at all, you're down almost 10%. This is a really big deal, and we're starting to see everyone focus on it. Let's give ourselves a little pat on the back here as crypto people. We've been talking about inflation. We've been talking about mismanaged fiscal policy for over a decade. This is the time we've been waiting for. I made a really cool tweet. Follow me on Twitter. I made a pretty sweet, I thought it was a sweet tweet. Maybe it's cringe, whatever. This morning, basically saying, I'm going to grab this tweet here quick. Let me pull it up because it's good. It's real good. There we go. And number one concern, I read this, the number one concern in the 2024 US election is inflation. Can you believe that? And recent polls are showing this is the number one concern. This is the reason Bitcoin was created. Right now is Satoshi's vision. Satoshi's vision is that the banking systems would fail again. In 2008, we saw a collapse of all kinds of things. Everybody remembers that. And the cypherpunks at the time said, we need a better system. We need a way where the control isn't centralized, isn't put in the hands of one person, because historically, every currency that humans have been able to print, we have printed it out of existence. The average lifespan of a currency in general, I believe, is 26 years. I think the average of a World Reserve is more like 50, maybe something like that. But guess what? The US is just coming up on that timeline, and we're seeing some very interesting things go down with it. Kind of lost my train of thought there. But basically, the two problems, inflation and, okay, so adding to inflation, we have seen the Fed, and this is not necessarily the Fed's fault per se. This is going to go down to I don't even know if fault is really to be blamed here. 2020 happened. It was a black swan event, and we did what we had to do. I do believe that, guys. I want to say this in this stream. We love to make fun of Mr. Chapow. It's fun, okay? I do believe that he does actually do the best job he can. I just don't think he or anyone is actually able to solve this problem. It's a balancing act that I don't think has an answer. So we had the black swan event in 2020. We printed a ton of money in stimulus to try to keep our economy afloat. It worked, but that resulted in the Fed's balance sheet exploding. I've pulled up here, exploding. This is through quantitative easing. Basically, without getting into details, it's making up money. It's really, for all intents and purposes, it's just making up money. And what that does is it creates a larger supply of money without creating a larger supply of goods. And that is the definition of inflation. Too much money chasing too little goods. In the last few months, the Fed has talked about quantitative tightening, meaning reversing that imaginary money. Well, here's the Fed's balance sheet. And let's zoom in. Let's just look at 2020 to now. Before March, the Fed's balance sheet was a whopping 4.1 trillion. That's still a lot, right? Since March of 2020, it reached a peak of just under 9 trillion. I thought it was just under 10, but just under 9 trillion. And since then, they've started to say we're going to perform quantitative tightening. So around the peak here is when they said that. I think you can see the problem. If this is the pace at which they're going to do quantitative tightening, it's going to take forever. I think they're something of the tune of $50 billion a month. That is literally never going to get us, literally never going to get this balance sheet back down. That will take like 5-10 years. So the Fed is in a very interesting position. I think one reason we're seeing not quite as much action, or we haven't up until this point, is that unemployment has remained pretty much where it was pre-2020. We have unemployment down at 3.6-ish%, something like that in the last numbers. That's virtually the exact same number of February in 2020. That, of course, spiked in the pandemic time up to 14%. And now it's back down. But that is a factor, I guess, hindering the Fed, or really holding the Fed back from making really big decisions, or really big changes, I suppose is a better way to put it. So inflation is becoming the issue, and it is the issue on the Fed's plate, and they are trying to combat it. And they combat this not just through the quantitative tightening, but through rate hikes. Every month we tune in here and we try to have some fun, watch them, listen to them, see what they have to say. And with these rate hikes, essentially what that is just banks lending each other money, how much it costs them to do that. That rate was down at virtually 0%, which we see typically at the worst of economic times. When, like, depressions, we have a 0% interest rate. We entered into March, into the biggest black swan event of at least my lifetime, at 0%. So this is a little bit of a problem. The economy is now, I think anyone can just call it a spade a spade. The economy is tanking. Stocks are down. I'll put out a little video about the Dow. Somebody sent me it on Twitter, caught a funny clip of myself. But stocks are down, tanking, and we don't have rates to drop. And in fact, we're in a position where we have to raise rates to combat inflation. So you can see how the Fed doesn't really have a great answer. With the tools they have, they really don't have a great answer. They can raise or continue to raise hikes or raise rates, which is what they're going to do today. I believe 75 BPS again. Possibly we'll see an 100 BPS or a whole percent increase. Last month it was supposed to be 50. It was 75. This month's supposed to be 75. Maybe it will be 100. But the problem is that puts pressure on markets, and so does quantitative tightening. This imaginary money they've made up, in order to essentially delete it, they have to sell assets off. And so that puts extra pressure on an already weakened market. So you can hopefully get the idea that the Fed is not in an ideal position. I do believe they're doing everything they can, but the options in front of them are pretty crappy. Historically, in order to combat inflation, interest rates have to come within 2% of CPI. At this moment, that we're nowhere close. So with stocks down 30, 40%, and even down for the year, we have to keep going, and we have to maybe even go faster. We have to maybe accelerate. We have to continue this pressure on the markets. So the Fed is now in a position of, do we tank the markets, which actually isn't their responsibility. So that may be the route they go. Or do they tank the dollar, aka do they allow inflation to get out of control, which they are tasked with, and I would say they aren't going to allow that to happen. No one knows really how this is going to play out, but it's going to be spicy. We've been covering these for about 2 years, and I'll say this. The first 2 years, this was not, or the first year and a half, these were not interesting. These have started to get very interesting, and it's obvious. We see everyday Joe, average Joe, talking about inflation. The world is really blowing me away lately. That used to be like crypto-only talk, and now it's like everyone's talking about it. It's the number one concern for the 2024 elections of the United States of America. It was every Bitcoin maximalist's number one concern since 2009. So we have a long way to go, and the options and the path to get there are far away and damaging. So it's going to be hella interesting. There is one option that I haven't really talked about, and this is the one I honestly think is what they should do. So basically the situation we're in now is due to kicking the can down the road, not taking action over the last decades, mismanaging fiscal policy, etc. And we're out of room to kick that can down. The road's done. Maybe they could find some way to build some roads real quick, kick it a little farther, but the timer, the countdown has already begun. So this might be an unpopular opinion. If I were in charge of everything, I would simply print more money, baby. If the problem is too much money, is chasing too little goods, in my opinion, what the United States needs to do is print a metric ton of money and build. That's the key. That is the key that didn't happen with the stimulus we saw in March, in 2020, the stimulus we saw, I believe, last year as well, this year. That's the key that was missing. When you print money, but you don't create more goods, you create inflation. If we were to print unlimited money, which the Fed won't do this because they're tasked for this not to happen, but we go and we build manufacturing, we build chip plants, we build battery plants, we build things that the future, we already know the future is going to need. How about this? We blanket the entire country in solar panels. There you go. A $10 trillion project. Sounds crazy. It would lead to hyperinflation of the dollar. It would be crazy. But what it would do, and this isn't offered really through the other paths, is one, it would prevent the economy from totally collapsing, which is a real possibility here in the next years, or maybe technically this year. But two, it's creating more goods. The U.S. is completely dependent on other countries for way too many things, and it doesn't always make sense competitively in a globalist market for the U.S. to make things here. I can acknowledge that. However, maybe it's more important that we just produce these goods than necessarily we do it the most efficient way. We've clearly mismanaged money to the point where we haven't done it efficiently, and that's led us to a lot of problems. So I say print, baby, print, and let's build freaking computer chip plants everywhere, solar panels everywhere. Let's build an electrical grid. Let's build, I don't know, let's get Elon Musk's like super train tunnel. It doesn't matter. Anything that will add value, literal value to the economy is what matters. Printing money, the PPP loans basically just went to businesses who put it into like buybacks of their own stock. That added no value to the economy. Let's build plants. Let's build nuclear power plants. Let's build things that actually add value and create products. That is the way I would approach it. It's not what's going to happen, but that's the way I would approach it. Also, that would very much lead to Bitcoin going to infinity if they printed infinity dollars. But for another day. Let's see, how much time do we have? So to run through here, we have 13 minutes. It is now 1:47. We have 13 minutes until the Fed releases its notes. I say this every time. I have no idea why they do it this way. Seems stupid. But they release the notes of what they're going to say in their speech to, I think, news sources, basically. Journalistic, I don't know. So what we do here is at 2 p.m. exactly, and that is 12 minutes now away, everyone gets on Google and we all search and search and search, and we try to be the first to see what their decision is. So basically, be a part of it. Please join us, be a part of it. Get a Google tab ready. Hit the wrong button. Get a Google tab ready and get ready to search, and anyone who finds the results, place it in the chat. Please, if you could, put the source. So if you say 75 BPS, say like Bloomsburg. Don't just say 75 BPS because people do that before the notes are even out, and it's just confusing. We like to be the first ones to know what it is. So 30 minutes after that, I guess Mr. Chirpow has to get his face on. We have his speech. So we're going to listen to that speech. And this speech, there's some interesting differences. The Fed has a tool that I actually haven't talked about, and it's more of a handshake agreement kind of tool. It's not a literal tool like quantitative easing or interest rates. And that's what's called forward guidance. Forward guidance has long been a tool the Fed has used, and it is really what it sounds like. The Fed is telling the market. It wants the markets to be prepared. Prepared markets are more certain markets, which are more stable markets. The Fed really does want markets to be prepared. It doesn't want to trick them. And so forward guidance is basically Chirpow coming out and saying, hey, inflation is even higher than last month, even though our rakes are higher. That's not a good situation. Things aren't looking good.
You suggesting hyperinflation, what would lead to products costing more dollars, so still no more products, just them costing more, also send a DM.
Correct. You are correct, Rico. I am suggesting that. I'll look at the DM. I want to get through this, but I am suggesting that because the alternative is probably hyperinflation anyway, or economic collapse without the building, without the fundamental value adding to the country. So my thought process, and like I said, anyone's welcome to argue this. This is just my opinion. I'm just giving you guys my insight, is if we're going to end up this way, let's build, baby. Let's build. Let's make things of value out of it. Oh crap, Discord wasn't loaded. Let's make things of value instead of ending up in the same situation anyway with nothing gained. That's kind of it. I could try to check this Discord message really quick. That's true. Sorry. Thank you. Riku corrected me, and he's right. I'm a little excited. If you guys can't tell, these are big days. I'm a little pumped today. I got a little ahead of myself. The Fed is responsible for fiscal. Wait, only responsible. Yeah, is only responsible for monetary policy. Sorry, not fiscal policy. That's a technical correction. You are correct. I was incorrect. Probably most viewers out here wouldn't know the difference. I didn't even think about the difference as I said it. Thank you, though. Rico, shout out to you, my friend. You are the man. Now I'm totally off track. He speaks it to forward guidance. So this has long been like a trust relationship. And over the last few months, over the last year, in my opinion, forward guidance as a tool has really had that trust eroded. I don't believe it's intentional. No one saw 2020 coming. The Fed had to act immediately in a black swan event. And so what the Fed also doesn't want to do is over-scare markets. It wants the markets to be informed, but it doesn't want to spook them with, unnecessarily. And so what we've seen is pretty much every instance of forward guidance being incorrect. Inflation isn't happening. Okay, inflation is happening, but it's not a big deal. Okay, there's kind of big deal inflation, but it's only transitory. Okay, it's not transitory, but we keep seeing these forward guidance notes not reflecting the future. And so last stream, I said this may very well be the death of forward guidance, as they said a 50 BPS hike, and then into this one was 75. But that's just a single instance of a long string of the Fed's forward guidance really being unreliable. But forward guidance maybe out the window. So that's going to make this one a little extra spicy because we're going to specifically look for and note the forward guidance today. And we're going to talk about it, have like commentary on it. And essentially that's going to be, what is today's rate hike? What's the current outlook today? What does next month's hike look like? Are we going to see an increase? Is inflation, is CPI, can we expect higher CPI numbers? We call these things hawkish and dovish. Hawkish being aggressive policy, dovish being passive policy. So if, say, we do go through a 75 BPS hike today, that would be neutrally hawkish. If we see 100, that would be hawkish. If we see the Fed say, hey, you know what? We found a magic lamp. We got 3 wishes from the genie, and we wished these things away, and now there's no problem, so we're not doing a hike. That would be dovish. So all we need is a magical lamp. If anyone has one, send it to Mr. Chirpow. That would be much appreciated. Well, what's up, 1,300 viewers? Oh, welcome back. Good to have you guys. If you're in the chat, say what's up. Sorry, guys, I wanted to get through all the info and stuff. I will read the chat. I am here with you. I will shut up once he starts speaking, so I'm trying to get everything in. Looking at markets today, we see stocks are up at the moment. This is from our last stream. I'm not going to spend time reviewing that, but that little fractal we saw didn't really play out, but it does look really similar. Let's get a fresher chart. Mr. Chirpow, let's just get rid of everything. So into today's meeting, we see Bitcoin, green candle, stocks, green candle. The dollar actually had a very strong day yesterday, is looking very strong again here with a potential higher low July 22nd, where we're seeing the dollar up, stocks up, and Bitcoin up. That's unusual. We rarely see that combination. And that actually makes me wonder what gold is doing, because gold can't be up. Gold's on a green day too. I mean, it's still relatively low in this month, but green day for now. What's up, my friend Patrick G? How you doing, brother? How you doing, Patrick G? Good to have you, my friend. Good to have all of you. You guys are the best. Don't forget to smash the likes, dude. Let's get to 1,000 likes. Let's get this stream hyped. Last FOMC meeting, we had over 2,500 viewers. We broke our channel's record. Let's break it again. And you can help that. You can help that happen by hitting the like button, voting in the poll, subscribing if you haven't subscribed, chatting, engaging in the stream in general. In general, if YouTube sees that people are engaging, YouTube says, hey, that people like this stream, I should show this to more people. It really does work. It isn't placebo. It makes a difference. So appreciate you guys. Dollars up today. Actually, though, in a doji looks almost no change. That's interesting. On a macro structure here on the daily, we do see a 20-year high, well, this month at 110. Damn, yo. Potentially here with a higher low at 106. And we saw some upside movement yesterday, a strong close. I think we're going to see this candle make some movements during the live speech. That's what we do. We watch the charts while he speaks. It's very spicy. Very spicy. Very, very spicy. I will say this. Caution, guys. Nothing I say is financial advice, by the way. Make your own decisions. I'm just sharing my knowledge and my insights and my opinions. Also, every FOMC meeting, I say this, I'm going to say it again. This is an extremely high-risk time to trade during these meetings specifically. Even the morning before, I would say maybe after the meetings, the risk simmers down a little bit. But during the meeting and just leading up into the meeting, very volatile price action is common. So be careful. I would not recommend trading from now until the speech is over. Maybe even into tomorrow. We have seen wild swings on assets, on Bitcoin, on the dollar. It's dangerous. Don't get wrecked. Get learnt, not burned. That's what we say. Get learnt, not burned. Let me pull the chat up here. 44% of us are looking for a 75 BPS hike. That's what was stated. That's probably the right answer. Combined 45, so an equal amount though. This is interesting. An equal amount of us also believe it will be 100 or higher. So we're pretty split here, with only 11% of us looking dovish at a 50 BPS hike. In my opinion, I think 100. I'm thinking 100. Here's my reasoning. We were supposed to have 50 last month. CPI was too high. They came in with 75. They got more hawkish. CPI numbers came out again. They broke a 40-year record. I can't imagine them coming on today and being dovish. So I don't think the 50 BPS is on the table. I think breaking that record is really going to light some candle under their butts, and I think they're going to look for 100. But hey, I might be wrong. That's why this isn't financial advice. I'm wrong all the time, guys. Life isn't about being right all the time. It's about having friends. And we've got some new friends. What's up, Mr. Prophet 74? Evan Dent ML, Milhorn Duvrako, Somali, T Skogt, Crypto Rambo, Patrick G with the $10, 10 euro super chat. Thank you, my friend. The euro not looking so hot. In fact, that's a good chart to have up too. By the way, it is 1:58. We have less than 2 minutes. We have like a minute and a half until the notes are released. So everyone, beep, 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 get your Google tabs open. Get your Google and tabs open. Fed interest rate hike. That's what I'm going to put in. Get your Google tabs. You can't see that. Get your Google tabs open. Try searching different combinations. Don't just type in what I type in, because there's really no point of all of us searching the exact same thing. We want to be the first ones to know what it is. I have a little secret on Google. If you go to tools right here, if you click tools, you have this weird little menu right here. Anytime, search it in the past hour, because before the next 60 seconds ends, no one has the exact answer to this yet except for the Fed. So in the next 60 seconds, get them ready. We're going to be looking to see if we can find this BPS interest rate hike before anyone else. Are you guys ready? Did you get your tabs open? Get your tabs. Get your tabs. What's up, Sylv? How you doing, beautiful Sylv? I hope you're doing well. But no time to flirt with Sylv. We've got 20 seconds for the notes to come out. Again, guys, please, once it hits, put the BPS number and the source. Please don't just put a number. It's not helpful. Not helpful. We've got 8 seconds to go. I'm going to just start spamming it. I hope that doesn't crash my connection. Hopefully my connection stays good today. How many tabs? All the tabs, bro. There's my alarm. It's 2 p.m. Let's go out there. Find it. Find it. Refresh. Go, 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 go. All go. Commando, go. Ooh, I just had an order fill. That's interesting. That means the market's just got hella spicy. No articles more than 1 minute old will have the answer. 100. 1,000. Ooh. Moon. I can't find it. You guys keep going. I just had stuff fill. Charts are moving. 75. 420. Source dead grandfather. R Lake. That's the best one so far. 75. BPS Bloomberg. 75. CNBC. 75 is in. Okay. Well done. I was incorrect. See? 46% of us out there got it correct. Well done. Give yourselves a clap. 75 Fox News. 75 is confirmed. We've seen multiple sources. Excellent. This is certainly not dovish, not overly hawkish either. This is more neutral. More neutral. Let's close this poll because we already know the answer. Sudden pump. Let's see. The dollar, we're seeing a little bit of green price action here. Nothing too spicy, no crazy breakout yet. Let's add some tight alerts. Bitcoin. That's a pretty hardy candle. I mean, it's not a huge candle, but that's a pretty erect. It's a pretty erect candle, if you ask me. Moving up. Interesting, interesting. Gold. I should grab stocks up here too. Gold unfazed. Gold's never phased. Gold is such a boring asset. I don't know why people like gold. I don't hate gold, guys. By the way, I'm more in the gold camp than I'd be in the stock camp. That's how crypto people are supposed to be. We used to like gold and Bitcoin. Stocks not really moving, at least yet. We see DJI, I mean, a little green candle here, but for the day, looking still net zero-ish. Big green dildo. Oh, I can't wait. Oh. On the 15. That actually does look pretty nice. Wow. Actually, Bitcoin reacting pretty positively to this 75 BPS hike. Whoo, boys, are we dollar dumping? Are we gonna get a dollar dump Bitcoin rally during the POWELL meeting? This stream is gonna pop the F off. Let's go. 22K. It's hard to get excited about 22K, isn't it? I'm just excited that these notes came out and now it's moving. That is why I say it's not usually a good idea to open a trade before these or during these. During the speech, we very well may see this totally retrace. That would honestly be par for the course. Bitcoin does that a lot. Tom Powell, what's up, Brad, James, Jonathan, Crypto Steve O. It's time to pump 26K BTC by the end of the week, says Crypto Steve O. I'll take it. Let's check in on our short position. It's going the wrong way for our short position. Since the last stream took profit, I believe that was in the last stream, 21.6, we closed some contracts, or opened. Yeah, closed some of our long at 21 short. God, I can't speak. I'm too excited. 21.6, we took a little profit on our short. 20,007, we took a little profit on our short. We added back, that's that swipe. 1/4 of the TP we took at 21,744, and now Bitcoin trading at 22.2. Let's get the big boy charts out. Let's LFG smash the likes. I'm doing my best not to curse like crazy today. I'm jazzed. I'm excited. We don't usually get any kind of price action this clean right before. I'll say that, this clean. New chart. I don't even know if I have time to make a new chart. I feel like there's not enough time. So we've got 26 minutes to chirpow. Can someone please, that has the skills, can someone please make me an air horn chirpow sound? That's like chirpow. Thank you. Thank you in advance. That would be dope. All right, let me just map out some macro levels here. I could easily just go to an old chart, but I want it to be a little cleaner. Let's look. This is the monthly open all the way up here. Yeah, see, you get a little wick. That's what I said. I would not recommend trading today. This is a nice big green candle in a 5-minute time period. We got a wick on top. Could retrace fully during the speech. It could fully retrace and then blast higher during the speech. Price action gets pretty nutty. It gets pretty nutty during these. Okay, so we're looking at our 24.2 high down to our 20,700 low. I think it's a weekly open 22.5. That's looking like the next resistance we're having above us. That's sitting just above our 618 retracement. This green line here using our Fibonacci retracement tool. Let me real quick look at the charts. That is some beastly power actually on the 1 hour coming from Market Cipher. Shout out to Market Cipher. Check them out. Use promo code CROWN. They sponsor our channel. They keep our lights on. And I use Market Cipher for every trade. So yeah. 5 minute. Let's start from the low time frames. 5 minutes showed a little bit of weakness. Actually, it showed a little bit of weakness, but this big green candle really pulling this money flow back up, pulling the momentum back up. Without that candle, this probably was looking to roll over. Same with the 15. Beautiful on the 15 here. Money flow on a higher high versus earlier. That's going to be a nice little continuation signal. Oh, but we have 8 minutes for this to close. Crap. That's a long time. If this was closed, that would be an awesome sign. So someone remind me in 9 minutes. Remind me in 9 minutes to see how this 15-minute closes. Actually, you know what I can even just do? Set an alert. There we go. On a good close here, 15 minutes going to close with a higher money flow high. I'm going to say, looking at the 5, that's going to be a little bit of continuation to the upside. Let's flip to the 30. Gorgeous. I went to bed last night looking at the charts, and I said to myself, these low time frames look awful. Like so awful. So we're probably going to see some upside. No, they looked so bad last night. Looking actually pretty solid here now. We can see this. We love to see this. We're seeing it here. Not necessarily money flow getting super high, but on the 30-minute momentum is not just positive. It's not even just accelerating, but it's remaining positive. We can see the bulls really holding that momentum up each time the bears try to take control on the 30-minute time frame. 45-minute, I haven't seen anything like this in a long time. Holy moly. If we get a strong close hourly. Have you guys seen anything like this? Holy shizzle. We have not seen anything like this in a while. This is some real spicy action. Looks like bulls on low time frames are really able to combat the bears maybe for once. It's been months since I've really been able to say that. Even the 90-minute, we're seeing a higher high. Lower VWAP high, that's not so great, but money flow is looking to roll over on the 2. VWAP refuses to go negative on the 2. Higher VWAP high here on a close. That pump was on the 2-hour open. Interesting. What about the 4? I don't trust the 4, but we do have a higher VWAP high. Money flow just rolled over. Things are looking pretty decent on a low time frame. 22.5 looking very probable. Again, not to be traded during this meeting, but those low time frames to me, they look like they want some continuation. That might even, though, look something like this. You know, we could see just flag out, maybe tap, reject, etc. You guys know how price action goes. The dollar still technically down. Let's mark this on our chart. From the release of the notes, that's right here, 107.1. Not a huge loss yet, or not a huge loss at the moment, but it is down, and Bitcoin is up on that announcement. So let's see how this plays out. I even have to put I accidentally just started that. I don't even have to put a line because we already have one there. 21.614, major support on the way down. I thought we were going to get a bigger bounce to 22.5. It fell through, but it was still a good call, good play. That's a major support that would be very nice and is a very confident place to bounce from. This is kind of a beautiful bump and run. I'm liking what I'm seeing here. What's the day look like? Well, it won't take much. Man, my throat's already dry. I'm so hyped. My throat's already dry. Won't take much for a bullish engulf on Bitcoin's daily today, 21.3. We're trading at 22. Resistance in our order block up here at 22.5-ish. That all makes sense. We don't know what will happen, but at least I have pretty good confidence that 22.5 will be tested here. Euro did find, as we totally, this wasn't on the chart. This was just something we said out loud. One-to-one parity. I think actually we've streamed since then. Euro bouncing from that 1-to-1 parity. Not a super strong bounce, though. Not a super strong bounce. A little bit of green off of today's dollar weakness. It's not really anything to read into. There we go. Gold got its little gold pop candle. Cool. What about Ethereum? How's Ethereum doing? Ooh, Ethereum looking very spicy, actually. We did not quite make it to 1,700 on Ethereum. We had been for months. It feels like, I guess it was just weeks waiting for the back test of 1,700. Was support to be tested as resistance. We came just shy of it about 3 days ago. Broke through 14.19. Looks like buyers came in intraday, settled up above support. Ooh, that looks spicy. A trade, not financial advice. There's trades to be made with this stop at just under support here. I'm not going to give numbers. I think that implies too much financial advice, which I don't give. All right, let's check out real quick the markets. Crypto markets, what's moving? LDO at $1.60. I don't think that's very far from where we looked at it last time, despite being up 24 hour on the 24-hour. Ethereum Classic. This is interesting. This is very interesting, actually. Ethereum Classic. Biggest gainer over the last week. Ooh, Monero looking good, too. Looks like our short got riggedy wrecked. Yep. Our short got wrecked, but it looks like our long is still in play. If I can move it. Unlock. There we go. Lock that baby again. Our short got wrecked, but our long is still in play. We went long on the previous stream. That was, I'm not really sure how long ago. 23.78. Actually, that was like 2 or 3 days ago. Last stream, I think we looked at this. Trading at $30. This is a weird. I get a weird vibe from this. I get a weird vibe from this. It was weird to see it move all the way to $200. ETC. If you guys aren't familiar, I'm not going to start a controversy, but ETC and Ethereum are from the same chain. Ethereum forked, creating Ethereum Classic. They have the same history up into the fork. So there's some speculation that maybe ETC has an edge here into the next few months, with Ethereum looking to move to proof of work or proof of stake from proof of work. Ethereum, of course, or Ethereum Classic, of course, remaining proof of stake that miners will move over. Maybe that's a value transfer, etc. I don't know how I feel about that. I'll be honest with you guys, as a crypto OG, Ethereum Classic rallying makes me a little uncomfortable. I'm a little uncomfortable, but we look pretty clear. Our entry was hit. I think we're looking pretty clear to $38.30. That daily on Market Cipher looking spice, looking real spice. What about this week? Three soldiers on the weekly, 4 days to close. Man, I have some Ethereum Classic, but I can't justify buying it. Because in my mind, Ethereum Classic is $5. Not 30, it's 5. Litecoin is 20. Ethereum itself is like 75. Bitcoin is like 5K in my head. All right, anything moving? DJI mostly sideways. Bitcoin holding on to the gains. All right, into this meeting. I'm going to mark on the chart vertically. But there we go. That's the released notes, and 1/2 hour later, boom, 2:30. This is when Mr. Chirpow is going to speak to us. Chirpow time. Chirpow time. All right, I think I'm good on my trying to run through everything craziness here. Let me check out the chat. LTC still 20. Yeah, exactly, Gio. Don't worry, guys. Bogged down. How do you say that? Bogdanov is on his way to dump it or pump it. I don't know. Whatever direction we're not going. XMR is very strong. Yes. We looked at XMR, I think, in the last stream or the stream right before that ended. It was showing some spicy. Let's see. Boom. Finally we got it. Finally breaking 154. That took a long ass time, man. Hitting that 618 retracement. Monero looking very good. What's really cool to me is Monero's structure is just different too. Most of the altcoins, especially the newer ones, look exactly the same. Their charts look exactly the same. There's really no difference between them. Monero's very much different. This low in May versus the low in June, we retook that low very quickly. We've already reached the 618 retrace. This maybe reminds me of something like Matic. Matic, unfortunately, I think did stall out at that 618. So that might be... Is this the right chart? That's not the right chart. I need to hire someone to go through my charts and delete them. It's like delete the ones that look crazy. There we go. Kind of similar to Matic in the sense of it moved back, retook that May's low, consolidated with higher lows, and broke out to the exact same point we're seeing Monero right here. That's actually, so maybe it isn't so unique looking. That's a very similar move. Unfortunately, if XMR is moving in the same way Matic is, we would expect to find resistance, aka the short we opened. We'd expect to find some resistance like Matic is doing at this 618, which is exactly this green line, where Monero is at right now. That green line. Going to be interesting. Definitely any position on Monero right now, if I were to take, would be buying spot, and it would be a long-term play. I would not touch this with leverage in any way, except for potentially looking to make this similar play to Matic, where we look to take a short, at least back to the consolidation zone. That went well. I hope people made money. That Matic play, man. Our long is still open. Now our short's open. The long, despite this downside, still up 163%. Can't complain about that. Bitcoin's looking a little spicy into the chirpow time, man. XMR BTC, I can Kev, don't worry. We love the BTC pairs here. We just don't have much time. You need to, BTC longs, they were selling off. Last I looked, they were selling off. Ooh, boys. I don't like this green candle. I don't like the green candle today on BTC longs, but what I do like is BTC longs falling. Seeing this falling pattern. I don't like that looks like a wedge, and we do expect wedges to break to the upside. I want to see it break to the downside. Probability would probably argue that with me, that that's not what we bet on. But we want to see Bitcoin longs, Bitfinex longs continue to drain down. Why? Because the timing historically has lined up with cycle lows or swing lows, macro lows. We saw, let's see. Boom. Right here. March 22. Wait, that's not the one. July 21 last year in summer. We saw Bitfinex longs reach an all-time high, or close enough. They began selling off. Bottom was in July 1st. We rallied to 69K. I forget the examples. I have too much energy today. I can't think of everything. So basically, we've been watching Bitfinex longs for how many days now? Over 40 days, waiting for them. I really want to see a closure of a large position. I'll take this bleeding, but if we zoom out, I have a feeling it's not going to be that significant yet. Like, let's look at the monthly. Yep. Looking at the monthly, it's like a baby teardrop candle. What about the week? Actually, the week finally showing some weakness there. 1, 2, 3, 4, 5, potentially 6 red weeklies in a row after this behemoth of a rally. Bitfinex longs, man, if these continue to sell off, it may signal that the bottom is in. Set your alerts. Check out this chart. I look at it every morning. I didn't look at it today because I was too hype. I was too much in the zone for this stream. Too much in the zone. Okay, we got those added back. Realized P&L. Now price is chilling. Give us more spice. Give us more spice. We've got 11 minutes. 11 minutes. Jason Casper shouting me out. Well, shout out to Jason Casper. I love that dude. Good dude. Smart trader. Fellow farmer. 75 BPS, Bloomsburg. Yep. 75 was in. 75's in. Now, if you go back, DVR is enabled. You can go back and see what I said at the beginning. I kind of went through the Fed, why they're doing things, what they're doing, their tools, what they're tasked with. We're talking about forward guidance. So because they're doing 75 again, here we go. Bitcoin moving, still moving as we approach the chirpow. Because they followed through with 75, unless there's like some surprise while he speaks, that's not particularly hawkish or dovish. Though we are largely dismissing forward guidance, we're going to be paying attention to it today. I really want to pay attention to his tone, his body language, the words choices his word choices, every little detail, because chirpow, even though he is a meme, he's also a human, and he reflects his feelings in his communication. As me today, I'm having trouble getting like complete thoughts out because I'm excited, because I'm ready for chirpow. I'm ready for this, man. We've got less than 9 minutes to go. You have just enough time to smash the likes and subscribe buttons. Getting soft. Super soft. I want a super soft birthday, Elo Brown. Shaky Pow. He was Shaky Pow the other day. Over under on a nose pick from Chirpow. You probably got pretty good odds. If you mentions recession, it's all down. So that's like part of maybe the forward guidance. As part of what we're paying attention to today is he going to say the word recession? Is he going to acknowledge the possibility of recession? Crap, that was something I wanted in the beginning of the episode. That was so relevant and good. Dang, I forgot. So the definition of a recession is, I believe, 2 red quarterlies on markets. Well, guess what? Instead of saying we're in a recession, we decided to change the definition of recession. Literally, changes the definition of recession. That's how we're avoiding it for now. I want someone, hopefully Gina, Gina, my love. Hopefully Gina asks how Chirpow feels about the changing of the definition of recession. Wouldn't that be a spicy ass question? How would you even answer it? Like, he'd probably just stumble over his words. Like, I don't know. I don't know. All right. Just under 8 minutes, and I'm going to be shutting up here. Let's smash the likes and subscribes and get hypes. I'll be chatting with you guys in the chat, and every once in a while I'll throw out some commentary if something strikes me. But let's get it hyped. Likes and subscribes. Let's see if we can break our viewership record from last stream. That'll be wild. How many we got right now? Showing me 1,700, but I don't trust mine. I don't trust it on my side. Shows me a bunch of stuff. 1,700, I'll take it. 1,700 beautiful people. We have 767 likes, which is quite a few. Can we get to it? Let's get to 1,000 right now. Let's get there before this announcement. We could do this right now. If you have not, pick up your mouse, put your finger on the clicker, put it over that little thumbs up, click it. Let's get to 1,000. If we get to 1,000 before he speaks, I'm going to give away a bunch of memberships. Let's do that. Gina. What's up, Karen? You're excited? I'm excited. I haven't been excited in a while. Markets have been so boring. I haven't been freaking pumped like this in a while, so I'm feeling good. You've invited your whole Discord. Oh, thank you, Die Hyperman. Dude, invite all your friends. Bring everybody in here. This is a family event. I've been trying not to swear. Be a family-friendly event. 950 likes. People are subscribing out the wazoo. Who do we got? Frank Chimix, Cal J, Atomic Clock, Rajan Zala, D Bajit, Gohan Might, Bryant. Good to have you guys. Thanks for subscribing. Woof. Man, there's so many. I have to turn that off while they speak. Woofmo Style, James Obleton, Jesus Sard Gonzalez Antonio, Funny 420, Damiola, Evan Lunchable. Dang, you guys are subscribing like crazy. Keep it up. Best part about subscribing is you get a shout out from me. Yes. Michael Iverson. What's up, my dude? Best Chirpow streams in North America right here. Best Chirpow streams. NA. Right here. And it's because of you guys. You know what? We have just enough time. I wanted to play this song for you guys. I've been enjoying it. It's a crypto song, and I have permission to play it. I hope it does. Oh God, maybe I shouldn't. Maybe I shouldn't, because like, what if I don't know if YouTube like algo will strike me right away? Because sometimes it'll strike you, and then the person with the copyright has to like undo it and be like, no, they have permission. But when it happens in your live, you get taken down. It's risky, but I want to play it. But it's hype. Let's play it. Let's just play it anyway. This is from Wrecked News. They have a YouTube channel, but I think they're mostly Twitter. And I guess they make crypto music, kind of like Crown Chakra. You can follow Crown Chakra on YouTube. That's CryptoFace's rapper dude who makes dope beats. So let me play this for you guys. We have just enough time. This is like the perfect segue. Make sure everything's ready. Let's go. I want the visuals too, though, because the visuals are kind of cool. They're part of it. It's got to be louder. Nah, it needs to be even bigger. Let's play it like this. Here we go. Ready? Good. Since we first emerged from the primordials, now Boom. Well, sorry if you guys don't like that kind of music. I do. You don't have to. But I don't know. I heard that song, that beat slaps. It's all crypto stuff. Like, all the terminology is right. I was blown away. Just came out a few days ago. Yeah, I don't know. I just asked the dude if I could play it because I was like, yo, that song slaps. Can I play it? And he's like, yeah, dude, for sure. All right. So I did. We have less than 1 minute to chirpow. So it's time to settle down or get hype. I don't know. One of the two. But it's time for me to be a little quieter. We're going to pull this up live. We do volume check. How's the volume on the background? That's just an 18-second clip. That's weird. Let's refresh the page. There we go. That happened last time, but we know the tricks. We know their tricks now. Okay, volume. How is like the background volume? Ba-na-na-na-na. All right, FOMC meeting officially has started. He should be on stage in the next few seconds. Next few seconds. Bitcoin at a very potential breakout here. We have a high, kind of consolidation, higher lows. Now we're retesting that high. As chirpow is entering the building, and as we break 2,300 viewers, let's go.
Good afternoon.
Good afternoon.
My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses.
Trying to signal strength.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate.
Inflation numbers
The pace
went
of
up.
those increases will continue to depend
So they'll go down.
on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a
broke the high,
decision
let's
that
go.
will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Answer the poll. Gina first, please. Shut the up, Rachel. Gina.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase.
Good question.
We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting?
Rachel.
Yeah, thank you.
Number two for me.
We did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Gina, please.
Thank you so much for taking our questions.
That's a
Colby
good
Smith,
question.
With the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
Perfect.
So,
Perfect touch.
I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Dollar's not liking this. Oh
Nick Timmerose of the Wall
my.
Street Journal. Chair Powell, you've
What up,
said
Nick?
that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next
Dollar's
year.
dumping.
Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderate.
Would you say that was a bestimate?
Somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that in. It's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to.
This question's getting him a little bit.
We will have seen 2 more CPI readings and 2 more labor market readings, amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina, please. Gina.
Hi, Jerry. Thanks for taking our questions. Gina Smiley with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with
best question. Shut up, Gina's talking.
I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Gina, more questions? Gina,
Steve
please.
Leisman, CNBC.
No one
Thanks
cares,
for taking my
Steve.
question,
Shut up.
Mr. Chairman. Earlier this week, the president.
Should we tweet Gina this? Yes or no? We're going to vote.
Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy? Thanks.
So we're going to be focused on getting inflation back down. And as I've said on other occasions, price stability is really the bedrock of the economy. And nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
They said recession.
Howard Schneider with Reuters.
Howard Schneider.
Particularly in regard to expectations, it's been said the last few months that the risks of doing
Mr.
too
Schneider.
little outweighed the risks of doing too much. Does that remain the bias?
Mr. Schneider.
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market.
Yes, sir. Mr. Chirpal, then why did we recently redefine recession? Your thoughts?
It's clearly narrowed, really based on events that are outside of our control, and it may narrow further. So,
I don't know.
I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been
It's
getting,
like Larry David.
if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and
Let's
imposing
go,
more of a
200
downturn on
weekly.
the economy
Let's go.
than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Today. Gina, another question? Gina, perhaps.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth, I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't.
Dollar dumping.
I mean, I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into
Daily
that. But
candle.
you tend to take first GDP reports
Bearish
I think,
engulfed.
with a grain of salt. But of course, it's something we'll be looking at.
Gina? Oh, you said
Hi, Chair
Victoria.
Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Katerina.
I did it.
Hi. Katerina Saraiva,
Got that
Bloomberg
email.
News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates, and, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So
Attention.
as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Chris.
Hi,
Chris?
thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI, we are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
The Gina tweet is live. Links in the chat. Retweet it, like it, comment, but don't you dare disrespect Gina.
There, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times, and it used to happen, if you remember, in the first quarter of every year for several years in a row. GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most, also, if you look at, I mean, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
He said COVID. We have over 55 likes on that tweet. You guys rock, dude. Let's make her follow me
at inflation
and be polite
as well. We, you know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels.
He spent this whole time saying that they were going to do this. Now he's saying if.
But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
We got 1,000 likes incoming membership.
So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see—
Because we redefined the definition.
Some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economists? Does that affect the soft landing?
Well,
we're way beyond soft landing. We gave that up a while ago.
We've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are.
Memberships.
If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand.
Vesemir!
You could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression.
200 weekly is broken.
Anyone who is
Boom.
really sure that it's impossible, or really sure that it will happen, is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News.
Oh, yeah.
I wanted to ask about the balance sheet reduction program. It's been working for a couple months now, and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments,
I'm ready.
The markets should be able to absorb this, and we expect that'll be the case. So I would
Chris!
say the plan is broadly on track, It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance.
It's Chirp
Looking
Pow.
at financial conditions, it seems like the tightening has slowed as of late with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Gina, more questions? Gina, please.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to
no, that's
before
impossible.
there was
Next
this outbreak
question.
Of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place.
Chris?
So I would say two things. One, I don't think that has materially changed the situation. But I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now.
Does anybody even think it mattered? What do you matter?
But,
that was a great answer.
Anyway.
Would it even matter?
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all those decisions?
That's getting tweeted.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it, and so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really in both 13 and 18 really had consequences for the real economy. 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how
200 weekly
complicated
testing
these
again.
supply-side
Let's
issues
go.
can be. We haven't seen this before in a long, long time, and so that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us,
important. Listen to this.
What is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion.
It's just so good that the bad data, you just can't even believe the data.
Very much, Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up.
That last question, we predicted it would be asked. It got him. He choked. He got caught.
Where we think it was before.
He was
and the
prepared,
reason
though.
is there's, it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side
Bitcoin
of that
hitting
is
23,000 above the 200 weekly.
As all
Let's
these
go.
jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the overtight labor market. So if you were to, you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
We may be looking at a close above the
thank you, Chair
200
Powell.
weekly
Jeff Cox from
today.
CNBC.com.
Fingers
Just a
crossed.
question about, hate to keep banging the drum about recession, but most of the polls that we're seing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. You know, going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
30 retweets, 110 likes. You guys are hype. Gina's going to follow me
FOMC has
by
historically
the end of the day.
tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
These questions are much better than usual.
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, you know, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got to.
Did he just say that you only worry about things going down when they're up?
In about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, you know, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that you know, in many cases their paycheck, it doesn't cover the food they're accustomed to buying. We're seeing actual, you know, real declines in food consumption, and you know, it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Go to Mark.
What up, Oliver?
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken
Bitcoin's still
chairman,
going. Let's go.
We're thinking today about the impacts of Fed policy on individuals.
You know, this guy's kind of boring. Obviously, Tom for president, but I'm not going to lie. Powell for president, I'd probably vote for him.
Fed policy means to them in this complicated economic landscape.
He's smart and he's well-spoken.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
He's done. There was no exit tro. He was just like, finish question, and you've talked too much about recession. We speculated they were going to ask about recession. Chair Powell was clearly prepared for that question and still got a little choked up. I really wish somebody would have hit him harder with maybe like, why do you think we've redefined it? Something that forces him kind of to put in an opinion about something. I wish they would have followed him up harder. You could see that for a moment, he like got caught up in his words. So that was not as hawkish. I was wrong again. I was expecting more hawkishness. You guys kicked ass in this stream. I love you guys, by the way. The Gina tweet, over 100 likes, 35 retweets. She has to notice us. But even more importantly, guys, go retweet it, like it, follow me on Twitter. More importantly, Bitcoin has retaken the 200 weekly moving average during the Fed speech live. That's pretty spicy. This is, in my opinion, the spiciest price action we've seen during a live Fed meeting. Looking over at the dollar not liking whatever Powell was serving. Little fake out rally. Or wait, it wasn't even a fake out rally. It was the second it started. So right here was when the notes were released. The second Powell started speaking, dollar dumping. Bitcoin giving me another alert. Apparently still going up. LFG. Normally we're done after the live stream, but I don't know. It's a little too spicy. Those low time frames we looked at right before the live speech seemingly playing out here. I wasn't so confident the 200 weekly was going to actually... I wasn't too confident that we were going to close over it. I was thinking maybe we were going to see a drop. We've seen a lot more volatility during these speeches. This was actually lower volatility as it was mostly just up. We've seen many whipsawing price actions during these. So I was kind of expecting to see maybe a retracement down, then maybe return to the 200. But this is looking at 2 5-minute candles closed above, maybe the third one potentially here. 15-minute closed above with only 2 minutes left. Let's get rid of these Chair Powell times. They're in the way. Chair Powell time. Chair Powell. I will say this, guys, extremely disappointed in how many times Chair Powell was said. It was a very low amount. It seems that we are in a Chair Powell bear market of sorts. Unfortunately. This is over, right? Yeah, he just walks off stage. We are in a Chair Powell bear market of sorts. Apparently, we're the only ones Chair Powelling lately. Used to be everyone was, now it's just us. That's okay. We're the Chair Powell holders. God, I hope Gina replies. I hope she replies to it. Oh my God. 140 likes, 40 retweets. That's pretty big. I rarely get things on Twitter bigger than that. I've had a few thousand like ones, but that was back when everybody was all hype. God, I hope she replies. I'm going to go through and read every single one of your comments, so keep commenting. Don't you dare disrespect her. Gina is a goddess. Don't you dare disrespect her. I'll go through, read all of them, like them all. You know how I do. Follow me on Twitter. Jump in the Discord. Let's we're gonna do a little navigating here. Make another new chart. Actually, this one's pretty new. This one's fresh. Let's start down here. So our 200 weekly. This is the important price point we're watching. I will say I did not expect, while Powell himself is speaking for Bitcoin, to retake this level. We have a very bearish weekly close, in my opinion, last week. Very bearish. We discussed this for weeks ahead of time. I said the only thing I don't want to see is for Bitcoin on the weekly to, say, overshoot the 200 and then get sold off into the weekly close. And that's exactly what happened last week. There is something that builds some confidence here for me. With 4 days left, it's way too much time to make a call yet for the current weekly. But something that gives me a little bit of confidence here is on the daily time frame, we can see price came back, tested the bearish engulf weekly, and now is back above the 200, or tested the bearish engulf on the weekly, then returned and is now above the 200 weekly moving average. So this was looking very, very bearish on yesterday's close for the week. Very bearish. Yesterday's daily close was not looking good. You can see that it went just beyond last week's open. If the weekly can close now above the 200 weekly, we are looking for higher numbers. That's 4 days to go. But with this bottom wick, that very easily could be the weekly low. If we can see a close above just like 22.7, we have some upside. We have some retracement to do. We have some pamping. Let's see where we might look for that pamping. Of course, 25.3. That, honestly, the only reason, or the only way I see 25.3 kind of being it, kind of being the only bounce we get, is if price action plays like this. Maybe we hit 25.3 if we get a good close in this weekly, and then in the next week, a back test of the 200 to move higher. I don't see that happening. I may be wrong, because looking back at price history, these recent sell-offs have been kind of similar to that price action. Not exactly the same. We had a high, then a lower high, then a dump. This would be a high, then a higher high, then a dump. So it doesn't exactly fit the pattern we saw in May. However, it might fit pretty well the pattern we saw in March dumping into May. So yeah, that's not impossible. Not impossible. But a close on the weekly above 22.7, 25.3, I think is a very good probability, not financial advice. But looking higher, we have our 618 retracement that lines up pretty perfectly with this year's January swing low 33. That's right above that previous May consolidation. That would be a pretty good target. I think the healthiest way for this to move would be the 25.3 back to the 200 in the next week, then a bullish engulf close on the week after that, giving us a move to, let's say, 33. That'd be a pretty good retracement. That'd be pretty good. Let's see what, it's been a while actually since I went back to 69, giggity K. 41, that's not right. Giggity. Guys, thank you so much for tuning in today. I'm still doing some TA because things are getting interesting while we're live. It doesn't happen usually during the FOMC meetings. But thanks for tuning in today. I had so much fun. These are my favorite days of the month, man. I've been streaming live here on YouTube for you guys for over 3 years, and I'm not gonna lie, it's not always interesting, especially, I don't know, the last 9 months been pretty boring, and I absolutely love and appreciate every single one of you for making these events, or making these FOMC meetings like events, like real events. Like, I look forward to them. These are our biggest streams. I'm not sure how many viewers. I turned off my studio because I think that lags me sometimes. I'm not sure what our peak viewership was. Last FOMC meeting, we broke our streams record. We had 25 or 2,600 viewing. I want to say we had over 2,000 at this one, during this one. I'm not sure. Let me see if it'll actually tell me. 25.3. We came just shy. Looks like we had about we had 2,000 coming into it. We fell off. As soon as the meeting started, we spiked back up. We have 1,300 likes. We have 1,300 people still viewing right now. I just appreciate you guys, man. Like, if this is your first bear market, you gotta, like, if you want to make it through a bear market, there's two ways to do it. One, just walk away. Don't think about it for years and wait until you see it in the news, your friends and stuff, and it's in the news again, then jump back in. That one's harder. The only other way to make it through is to find a community of people. That's how I've done it. That's how everyone I know who has been successful in crypto has done it, is to find people that are like-minded. Doesn't necessarily mean they have to be bullish or bearish like you, but just crypto people that are also around, because our friends and family, they don't understand what bear markets are. They don't understand the emotional, the stress, the feelings, the weight it has on your life. And these community members, people like you and me, we're all going through it together, and there's strength in that unity. So I hope our community is right for you, but I know our community isn't right for everyone. So if it isn't ours, I hope you find the right one. But that's the single most important thing, I think, for surviving a bear market. Find a community of people. Unfortunately, you got to enjoy hanging out and talking to them a little bit. You don't have to love them, but find people to, let's say, bear with it, right? To bear with it. It's going to make it a lot easier. It's going to make it possible. This is so freaking spicy. The 1 minute literally back testing the 200 weekly here. Is it going to find buyers? Is it going to find buyers? Volume is increasing. We have some pretty clearly increasing volume here. I like that. Well, with price. Actually, that's very good. That's very good. Let's take this little cut of the chart. Let me make sure I took all the other crap off so you can see. Goodbye, Gina Hart. I love you. Goodbye. Okay. What's up, Twins Problem? Man, we have so many subscribers. I'm sorry I didn't shout everybody out. Usually we shout everybody out, but that would have been really impossible during this stream. Real quick, Leah, I don't know. Rajiv, Caitlin, Awesome, PKing Twins, Apo, Sorwar, Pekka, Michael, Oliver, James, Chris, Garrett, Kevin, Wolf, Drufel, Aunt Timia, Koi, Mr. Just, Boy. I got a lot of them. Thanks for joining, guys. Thanks for subscribing. Make sure to check out our live streams. We're live here all the time. Make sure you're in the Discord. We do live airdrops after every stream, so you'll get some free Satashis just for watching. That's right. Just all you have to do is be in there. You don't have to do anything else. Taking a look at just this really local price action. This is on the 5 minute, but this is a good lesson. What we have is falling price, price found support, price reversed, okay? But what makes this actually interesting versus that isn't a really interesting story is price reversing also, we're seeing volume increase. That is a good sign. While price fell, you can see the volume down here, it's almost nothing. Price was falling, volume was falling. Traders weren't agreeing on price. Now price is increasing, volume is increasing. Traders are now in more agreement on price. That's a good sign. That is a good sign. We were looking at low time frames. We were waiting for this 15 minute. If anybody reminded me like I asked, kudos. I certainly was too distracted to read it. We were waiting on the 15 minute here on Market Cipher. Check out Market Cipher, by the way. I use this tool for every trade. They're our sponsor of this channel. We were waiting and hoping that the 15 minute here, that this green blobby line would make a higher high. This is money flow. Money flow did make a higher high. That is a great sign. We said at the beginning of this episode, if we get that close, we're likely looking for continuation to the upside. We just tested the 200 weekly. Hopefully we're still over it. We're flirting with it. I could see today just like trade sideways, dick around on this 200 weekly for like as long as humanly possible. Just, it sounds too painful not to be true. Let's look at that 30 minute, beautiful. These low time frames going into this, DVR is enabled, you'll be able to watch it after. Going into this meeting, the low time frames were phenomenal. We looked at them and I was like, wow, this is the most kind of bullish Unfortunately, it's only like the 30-minute, the hourly, it's not the daily, monthly, big time frames. But these low time frames are some of the most bullish we've seen in months. That played out. That played out pretty well. 30-minute here, money flow is just trucking up, momentum breaking highs. It is looking for maybe a short term on the 30-minute pullback, maybe this red candle. Yeah, that explains this red candle. 45-minute less of that pullback, just trucking straight up. VWAP highs coming up, money flow coming up. Money entering this market. Look at the hourly. Look at this beastly freaking momentum on the hourly. Look at it. Look at this thing. No F's given. It's like, have you guys ever seen Naruto, the Lee fight in the first season of the show, where he's wearing the weights and then he takes the weights off and then he kicks crap out of Gar, but then Gar beats him up. Anyway, I'm a nerd. That's what it's like. It's like all of a sudden Bitcoin just dropped its leg weights and now it's like, I'll show you my true power. Let's hope that this is going to extend out to higher time frames. That's what we need. That's what we need to see. The 30-minute, the 45, the hourly, 15, 5, whatever, looking good. That's awesome for our scalp. It's awesome for scalping, but it's not telling us a market direction. It's really just telling us potentially what might happen in the next few hours. This is the 90-minute, and it's just everything kind of looking the same from very low momentum to very high momentum. That is a fragile state, though. When you get those setups, you can see it just snap back. What I do like, positives here, 90-minute money flow is about to roll into positive. It's been negative since the 25th. It was only positive for a few hours, but it's rolling over again. I don't love that there's a lower low here because you have the threat of that happening again, but we're going to hope that maybe the 2-hour or the 4-hour something has something for us, and we do. The 2-hour, way more beautiful than the 90. Look at this. Boom. Higher high in momentum. Easy. Higher high on VWAP. VWAP just staying positive. Not just refusing to go negative. Money flow absolutely giving us the symptoms of a rollover, looking to go positive. Looking for money to start re-entering the market as opposed to fleeing the market. Let's keep going quick. 3-hour, I've never seen anything really quite like that VWAP. That's wild. That is wild. Holy heck. The 3-hour, we broke our recent low. After setting a lower low, we've broken our low. So now we can say we are going to look for the 3-hour to roll over as well. I would say momentum and VWAP back that up. Let's see the 4. That's the 5, baby. 5. I get 5, but 4. 4-hour leading the 3-hour. Here we have positive money flow. That's what we're looking for. Just, I think it's in this candle, so unconfirmed. 18 minutes. Oh, God. I'm going to pull my hair out, man. This 4-hour is going to close in 18 minutes. It's going to close right at the 200 weekly. And then if you watch this channel, you know what I think is going to happen. I'll just spend the next 4 hours doing nothing. The 4-hour loves doing that. But that VWAP is rocking and rolling. A good close is going to put the 4-hour back in a good position. Our MACD showing momentum is building, is accelerating our buying momentum. I actually don't like that because if we get like a decision candle, we might lose that VWAP. We might lose some of that momentum, and it's still not over into positive territory yet. It's still a negative. So I'm going to hope that maybe our 6-hour in very similar condition. But we did get a fake out. We would have been looking for money flow to roll over from positive to negative back in the 23rd. That did not happen. So what we're going to need on the 6-hour is a higher high on our money flow, like we saw in the lower time frames. It's very confidence building to have seen that on the lower time frames. VWAP, higher high. That's good. VWAP, we had a lower high here on our lows. Momentum, we did have a lower low, but most signs on the 6-hour here, I think are looking pretty good. They'll be confirmed on a break of a higher high in money flow versus July 18th. We don't have it yet. That would imply we need to close above the 200, and we need to, I would say, at least move to 25.3 to get that money flow in position. 8. We got a green dot close. Money flow is looking to roll over. It's very close to red. We would typically say, hey, this is going to go to negative money flow. Pretty much the VWAP is holding on here VWAP's holding that money flow on. It's got 4 hours, closes with the daily. I hope we don't get an indecision candle. I hope we get a clean close above the 200, but life's never that easy. 12 hour, actually very interesting. 12 hour reminding me of the 4. Except the 12 hasn't... Ooh, I gotta close that. 12 hour hasn't actually rolled over yet. VWAP's up, momentum's pinched. It's looking for upside. No take here. I don't have a take in the 12. I think the 12 is like basically indecision at 22.8. And of course it is, right at the 200 weekly moving average. And here's really what it is, guys. This is all I've been watching for days. This is it right here. This is the daily on Market Cipher B. Money flow starting in April of this year, negative. Money started flowing out. It accelerated, found an apex May 27th. We had a wick low. We still had money leaving the market, but the pace at which it was leaving was slowing down. That's what we see here as that red blob moves upwards. June 9th, that reversed again. Money began flowing out again, faster and faster. The good part is that it never exceeded the speed at which it was originally accelerating out of the market. So we had we'll call it a higher low. We had a higher low. Money flow began receding again. We had another higher low. And right here is when I started getting excited, right there, because money flow was leaving the market slower than it had been since basically it started. We got another lower high, and we're all the way zoomed in here. Look at how close we are. Look at how close we are. VWAP on the day, on a strong close today, VWAP is going to look for positive. It's going to look to go positive. Momentum could line up with that virtually at the exact same time. We're coming off of a very weak bearish selling period that back in mid-July, very weak bearish period here, off of a very weak bullish period. But we've broken our highs on momentum. And so that's confidence building. With money flow so close to zero, all we need to see is some little kick in the butt. And we're going to get one of those bigger retracements we were looking for earlier. This is like the only thing I'm watching at the moment. I want to see the daily close with its momentum pinched. Pinched meaning one of these little dots here, showing that the light blue and dark blue moving averages, light blue being a shorter moving average, dark blue being a longer, have essentially done an MA cross. That's what we're looking for here. But this is momentum instead of an average price calculation. Oh, this is spices. This is spices. It's like we touched the 200 even on like the 5 minute, and now it's finding like some buyers. It hasn't moved, but it hasn't dumped through the 200. Hasn't dumped immediately back. I wouldn't call this a rejection. Even the 15 minute, you see the bears were unable to bearish engulf the previous candle, which did get heavily sold off on the 15. 30 minute nowhere close. You have a little local resistance at just about 23,000. We see that on the 30 minute. Yep. Up. Yep. Let's go. Let's go. I think the 5 minutes still saying continuation. I think the 5 minute is still all about it. All about that continuation to the upside. If only the 5 minute were a longer time frame. Money flow just setting high, continuing to set higher highs. The only red flag we have, we didn't actually have a higher momentum high. So this may be a suggestion on the 5 minute that there's some retracement ahead, but money flow is the bad boss. It's the captain of the ship. It's the captain. Money flow pushes this momentum around. So as long as this continues, I think we have a little more continuation on the 15 or on the 5. So that's what I'm hoping for. I think we're seeing just some kind of retracement of these gains, maybe a very shallow retracement. Let's see what the hourly has. We're not even in retracement. The hourly candle's still green, or like not even retracing. We're not even, I don't know. Close above the 200 weekly today. That's all that matters. All right, I have to eat food. I'm starving. I burned so much energy during the stream because you guys rock. I love you all. Make sure you've liked and subscribed. I saw you guys did a ton of subscribing. Maybe I can run through some of the names quick here that I missed. 911 Jim Lee. What's up, my man? Sasha, Ben Yu, Alex Wells, Mustafa, Kunsuk Kim, Kim Peeln, Axis Alive, Ollie Sherhan, Twins Problem. I think I got most of you guys. I love you. This is one of the best FOMC meetings ever. And because of you, the viewers out there, I had a great time. I hope you had a great time. Let's pray that Gina sees our tweet. That would make my life. That would make my whole life. Wait, where? Here we go. It currently has 44 retweets and 150 likes. That's damn good. Here's the tweet. Give her some love. Don't you dare disrespect Gina. She is a beautiful lady. My love for her is not disrespectful. So feel free to comment something nice or don't say anything at all, but please retweet, like it, etc. Get it hyped up. If she replies, I don't know what I'm going to do. I'm going to do something special for you guys. Pay you back. Anyway, jump in the Discord. Why? Nothing has worked. At least our connection wasn't the worst. Thank God. Jump in the Discord. Links in the chat, in the video description below. Check out our sponsors, Market Cipher and Phemex, two of the best in the business. Check them out. They keep our lights on. I love you guys. Watch for the daily to close above the 200 weekly today. Price is exactly at it. I'm not going to sit here for 4 more hours. I love y'all. See you in the Discord. Crown out.